Eileen, thank you for that. Did you have anything else, Eileen, that you wanted to add before we begin?
No.
All right. Well, let me introduce our two presenters, probably well known to most of you, but nonetheless, Barbara Baker-Omerod, practicing attorney in Owasso, with an emphasis in family law, estate planning. So we're glad to have Barbara with us tonight. She is president of the Owasso Club and very involved in the community here and in the village of Lennon where she lives, in addition to all that she does for Rotary and for her legal practice. And then we have Andrew Matuzik from Saginaw. We're glad to have you participating tonight. Andrew is a CPA and a PFS. Did I get that right?
Yes. Yep.
Okay, personal financial specialist, correct? Okay, with a lot of experience in estate planning and the taxation issues around those plans. So they're both going to talk for about 15 minutes or so. We hope to have some time left at the end for questions. And perhaps if you have, very specific questions that you'd rather not share in the group, you might be able to reach out to either of them one-on-one. So with that said, Barbara, are you with us? There you are.
Yes.
Okay.
Sorry.
So
I keep myself muted.
Okay. So Barbara, let's start with you and come at this topic kind of from the legal perspective and share your thoughts. And before you start, so just hang on a second. I'd like to welcome John Oliver, who's just joined us from the Owasso Club, and Amanda Schaefer, who has also just joined us from the Mount Pleasant Club. So welcome, and we're glad to have both of you tonight. Just in case you're not aware, both of you are muted. So if you would like to ask a question, just recognize that we won't be able to hear you until you unmute. And Barbara, we'll turn back to you and take it away, please.
Sure. I'll start off just with a little bit of the basics, which I'm sure most everybody's familiar with, that a will is a way to tell the world, specifically the probate court, how you want things distributed. You name who you want to be in charge of doing that. That is now called a personal representative. Your personal representative is charged with the obligation of dividing and distributing your assets as you would wished. So that can be to people, that can be to Rotary, it can be to any of your charities, but your assets have to be in your individual name at the time you pass away to be included in your will to go through probate. So I get a lot of people asking, well, I want to do a will, but I don't want to go through probate. A will does go through probate. It's probate system since the year 2000. It was been revised and revamped. It's very simple, straightforward compared to what it used to be. So we can pop in and get letters of authority for your personal representative and pop back out and do the final documents, and we don't ever have to see the judge. Of course, if you have people that are fighting, that becomes litigation, and that is a big pain in the neck, but that can happen in trusts as well, or without any of that too. As we all know, anybody can sue anybody for anything. That's why there's so many attorneys around, so I apologize to the world. You can, if you go through probate, it's usually a pretty quick process. What the courts encourage us to do with the will is have that administration done in a timely fashion. I like to try to get things done. The requirements to wait is you have to publish in the newspaper for creditors. Then you have 4 months from then for anybody to come and say, hey, you owed me some money. And then you can close the next month. So for a while there, we were having trouble back 2008 that the houses weren't selling. So we would stay open longer. But now we are able to usually go forward very quickly and get things done and have people on their way. So if somebody wants to say in their will, I want $10,000 to go to Rotary, you can have that either as a first gift and then everything else divided between other people or percentages or things like that. Or you can do it as the opposite way. I want to give my 3 kids half of my assets and the other half are going to go to Rotary. You can do any which way like that you like. It's a matter of, you can legally in Michigan do a handwritten will. Holographic will does not have to comport with the requirements of a will. It really needs to have a date indicated is your will, or this is how you want your assets distributed, and your signature. It can be very problematic from the standpoint of they're not as recognizable to other attorneys and judges that are used to seeing them with the standard signature requirements and these kind of self-proof clauses that help us get through the probate process relatively quickly and easily. But that's a benefit of finding an attorney who does wills and trusts regularly, is you can just go to them and say, this is kind of what I want to do, make it happen. And so that's our job, is to make that happen. So if you die with your house, bank accounts, retirement accounts, personal property, guns, jewelry, all that kind of stuff that is owned by you, that has to go through probate to change ownership. Personal stuff, not really, if there's not a title or anything like that to worry about, but that is a mechanism to show how it's going forward. So if you don't have a house or any investment accounts that don't have beneficiary designations, you could just look at the people around you who are supposed to get the gifts and say, everybody good? We all agree that this is what's happening. Otherwise, one of the people can take it to court and say, we're not agreeing. So there's your referee that you have there. The trust, on the other hand, is a contract that you enter into with yourself, usually, to become the trustee. You transfer the ownership of all of the assets that you want to be managed by your trust to the trust. That really irritates a lot of my clients. They don't want to have to bother with all that extra paperwork. Trusts cost quite a bit more than just a plain will. So it's almost 10 times as much, depending on who does it. I usually do an individual will for about $200, and a trust is a plain simple trust is usually about $1,500. A trust does come with wills and powers of attorney, those two, so it's some little bit less expensive than it sounds. But what it does is, like I said, you have to have everything owned by the trust to then be managed by the trust, which is nice to have that management during your lifetime. To manage those assets, you do it individually as your own trustee until you're disabled or die. Then your successor trustee takes over. Same kind of thing. You can have it that your trust gives out a flat percentage, a flat amount, anything you want to Rotary, and then the rest goes some other plan. Or you can, I have 3 kids, so I'm going to divide it in 4s. Rotary is going to get a quarter. You can do anything you like to with that. The real good reason to have a trust, in my opinion, is to manage your assets. Either you're expecting to be disabled and you really want somebody else to be in charge of that, or if you have somebody that asset-based income or benefits from the state or the federal government, somebody who's having, for example, an opiate issue that they can't really manage a big bunch of money, so you hold it sideways out there. You can also do you don't like what's looking like in somebody's marriage and you don't want that to become part of the divorce. You can have that held in that trust to manage that. So I like to think of it as the puppet master plan, that if you really want to mess with people after you're gone, then that's the way to do. I end up accidentally talking most people out of trust by accident. It's a bad business plan on my behalf, obviously, when they're more expensive, but I have dogs that nobody will take care of. Usually they're spoiled brats and all that. So I have to dangle some money out there that somebody will take care of my dogs until they pass. They're not going to be the ones who get the money because the dogs will be gone real quick. So then it transfers to somebody else. So I can have all different kinds of scenarios set up. If this happens, then this happens, and that's great. So same thing though. However you want to give it to Rotary, it is a wonderful avenue to do that. You can do any amount. I like to often suggest to people that they do percentages, because if we start off with $2 million and we want to give somebody $1 million, well, if we've used down to we only have $500,000 left, that first $1 million that first gift is going to get everything. None of your other people are going to get anything. It's that first gift that gets after the expenses of the administration are paid. So wills are great for just getting things done and moving on, and to have that benefit of taking care of you while you are alive, like the trust does in the beginning. You can have powers of attorney to handle that too. So the other option, other than a will or a trust, is a flat out beneficiary designation. Those are really nice if you just want things to go. You can they also call transfer on death or payable on death. I got in an argument with a bank supervisor one time that told me that they didn't have such things as beneficiary designations. yes, you do. So we got around to, they were just using a different term. So, but those are really easy way to do. If I just want my kids to have this money as soon as I'm gone, that they can deal with it. The Edward Jones, Wells Fargo, Stiefel, all of those people can handle those to transfer those assets right out. And it's doesn't involve paying for a trust up front. There's no trust administration after on those assets, and there's no probate administration. So those are quite quick and easy. The only problem is that money goes straight to those people. So if you're worried about how they're going to do, it's going to kick them off their Medicaid or Social Security, that's an issue to think about with that as well. But you can put Rotary as a beneficiary. You can say, you know, if I have this account when I die, it can go straight there. You have the options with giving to Rotary. You can pick. If you go to Rotary.org, they have all kinds of options that are really interesting to look at. What are you interested? What would you like to benefit? And why not benefit the things that you think are great? So we have the featured causes, which include the annual fund, the polio fund, World Fund, or the disaster response fund. They are all eligible for Paul Harris Fellow recognition. You also can pick areas of focus, which do not generate district designated funds, but those are the environment, peace building and conflict prevention, disease prevention and treatment, water, sanitation and hygiene, maternal and child health, basic education and literacy, or community economic development. You also have the option of endowments. There are two right now, the Rotary Peace Center Endowment and the World Fund. You also can choose global grants. You have to have the 7-digit grant number, but you can pick to donate to a specific grant, just however you would like to do that. Then if you want to pick what kind of assets would be more beneficial to you, that's an interesting thing too. Right now in Michigan anyway, you do not have Michigan estate tax, also called inheritance tax, depending on who you're talking to, or which way people are looking at that. Right now, I can give away, well, not I can't, but people that have more than $11.7 million can give that away free without any tax implications to the receiver of that. As a couple, you can, again, you all can give away $23.4 million. Personally, I don't want to spend a whole lot of money on a tax avoidance trust to give somebody 11.7 million. They can pay tax on the rest of it after that, as far as I'm concerned. I'm not very nice that way, but it's a 40% tax. So that is something to be looking at, is if you want to do that. The really cool thing that is beneficial right now is if you have your retirement funds, IRAs or 401ks that are income tax deferred. So that's not your Roth. Your Roth, you've paid the taxes before you invested it. But if you have an IRA from a 401k from an employer, an IRA that has all tax deferred income, when you give that away, or just like when you take it out, you have to pay income taxes on it. So if you want to give that to Rotary, which is, you know, really cool, then you I read this and I quoted it because I think it's really cool. The Institute of Continuing Legal Education's book on charitable trust. Directing the payment of charitable bequests out of retirement assets is often an efficient means of meeting the client's charitable goals while completely avoiding the payment of otherwise deferred income tax. One of the problems can be, you have to worry, well, not worry, but if you want to give these assets also to humans that are individuals instead of Rotary, that they used to be able to stretch it over their lifetime. And our CPA, Andrew, will probably be able to explain that a whole lot better than I can. But now we're back to 10 years on people. But if you add Rotary and it's a combination, then it goes to 5 years. So you might just pick to give those to Rotary or give other ones to individuals that can stretch it a little bit more. But Rotary can deal with all of that however it comes to them. You just want to make sure that if you are giving the money to somebody that doesn't want to have it all at once or within 5 years, that that's something that might be more interesting to you to do that. But again, so if you give over $10,000 to Rotary, you get special classification, and even if it's in your estate plan. So that's a wonderful option to do, again, however you want. But if you do this percentage, then no matter what you end up with, before you pass away. If you win the lottery, like my plan is, with that 400 millions, I bought that. Well, my husband bought it for me because he keeps track of me. But if I get that by accident, then it's great because all my percentages just are a bigger gift to people. If I give a specific dollar amount, if I give $10,000 to Rotary and I end up with only $5,000, Rotary gets it all, which is fine. But then the extra gifts I gave later do not come in. I don't know if I went over my time again. I do tend to talk and kind of fast sometimes, but often not fast enough when it's stuff that people are interested in hearing. So if anybody has any specific questions, I'd be happy to answer them or answer them after we hear from Andrew, whichever way anybody likes.
Any questions you would like to pose to Barbara while it's fresh in your thinking before we move on? Jeff, I see your hand up.
Yeah, Barbara, great job. Thank you. So question, if a grandparent wants to leave assets to a grandchild at a certain age, is that best accomplished through a trust, or can you achieve that through a will?
You can achieve it either which way. You do potentially have issues of the generation skipping transfer tax that you'd want to look into. And I haven't done those in a long time, so I didn't look that up. But so you can do it any which way you want to. If the grandchildren are minors, it's nice to have it in a trust so you can stretch it out past 18. If you give a gift to a minor in a will and it's more than $5,000, the probate court requires that to go into a conservatorship, which usually their parents would be in charge of. And usually, at least our judge does not let you really touch for almost anything because they want that money to be available for those kids when they turn 18. But if that is over $5,000 and they get it the day they turn 18, many of our seminars we talk about, they get the most expensive car for the least amount of time. So you really want to be careful with some of that with if they get that money right away. So if they're young or you're not sure how they're going to spend money when they get old, you can have it. I had a gentleman who did, and it was actually to his own kids. He didn't let them to have any of the money until they turned 55, and then they only got 10% of it. So I don't know what they had done wrong in their lives, but that was kind of rough. But you could, that's where a trust is really helpful if you want to manage that. You know, if I want to say, hey, I was going to give you some money, but you went to U of M instead of Michigan State. Sorry about your luck, which I know that doesn't go well in most crowds. Half and half. But you can really manage it down the road like that. And it's I think it's fun, but I'm terribly warped from doing this too long, I'm sure.
Right. Okay, thank you. Yeah, you know, most millennials tell us that they don't become an adult till age 27. So I'm kind of setting that date as a or that age. Thank you.
That sounds reasonable.
Anyone else? All right, very good. Thank you, Barbara. We appreciate all of that information condensed very nicely for us. So we thank you so much. And I'm sure we'll come back to you in the end with potentially some more questions. So hang on with us. Andrew, let's turn to you, please, and hear this topic discussed more from the taxation side of the issue.
Sure. I'm going to go ahead and share a screen just because I've got a PowerPoint presentation up. So give me one moment. Everybody see that?
Yes.
Perfect. All right, so yeah, my part of this presentation is really going to focus on what you can do now, not so much what you're going to plan for after you pass away, but maybe some ways that you can actually utilize charitable giving to reduce your current income taxes. I'm going to talk about 3 different topics, current federal income tax law and the CARES Act. There were some changes in the last year that made charitable giving a little bit more appealing. And then donor advised funds as a planning tool, and then donating retirement assets. All right, so the Tax Cuts and Jobs Act of 2017 changed the tax laws in a couple of big ways. The first one was reduction of individual income tax rates. Nearly all of the tax brackets went down in rate, so that was a tax savings for the majority of taxpayers. There were some taxpayers that didn't get a tax cut. However, the majority of taxpayers did end up paying lower income taxes from that bill. Increased standard deduction, which we're going to talk about that one more specifically because that is probably the one that has the most impact on charitable deductions. And then the increased estate tax exemption, which Barb did mention. It's very lucrative right now, $11.7 million. So, okay, so when we talk about one of the biggest changes for individual taxpayers with the Tax Cuts and Jobs Act, it was the increase in the standard deduction. I think in 2017, the standard deduction was a little over $12,000, so $12,700. And then you'd also get personal exemptions of $4,050 each for if it was a married couple, you and your spouse, and then any of your dependent children as well. And then in 2018, when the TCJA took effect, the standard deduction actually went up to $24,000 and the personal exemptions went away. So that was a big change. And it really impacted a lot of individual taxpayers that used to itemize. So now under current laws, charitable giving, not many people actually get to deduct their charitable contributions anymore because of that standard deduction increase. So we're going to talk about a couple of ways that you can get around that and be able to take a little bit more tax advantage from those charitable donations. So, and just to kind of give you an idea, back in 2017, nearly 30% of tax returns itemized deductions. And in 2018, that went all the way down to 10%. So that's a huge drop, huge. All right, so the CARES Act, this was passed in, I believe, March or April of 2020. And one of the big things that came out of that for charitable deductions, it actually allowed a $300 deduction above AGI or included in AGI on your tax return. They had to be cash donations, but you didn't have to itemize to deduct some of your charitable giving. And in 2021, that's actually going up to $600 for married filing joint, and then $300 for single. There was also an increase in the AGI limitation for charitable donations in 2020. So taxpayers could give for cash donations, they could donate or they could deduct up to 100% of your adjusted gross income. So you could virtually pay no federal income tax if you gave away basically all of your income for that year. And I think the typical average in the Tax Cuts and Jobs Act was 60% on cash donations. So, and then just a quick note, we're going to talk about donor advised funds later, but those gifts, these rules don't apply to gifts made to donor advised funds. It's strictly just cash donations. Okay, so what is a donor advised fund? It's a fund held by a charitable organization that is separately identified through the contributions of a donor or donors, in which the donor or persons appointed by the donor has advisory rights with respect to investments and distributions. So basically what that means is you can donate to a specific fund, keep some of the control, and you actually have time to decide who you actually want to make those donations to or what charitable organizations you want those funds to go to. So the nice thing is you get that tax deduction when the gift is made, and then you have multiple years to be able to decide what to use or how to use those funds. So when you're donating to a donor advised fund, cash is a deduction up to 60% of AGI. So if you have an AGI of 100,000, you could donate $60,000 of cash to a donor advised fund and be able to deduct the entire portion. Whereas, and this is what we're going to get into because it's a little bit more, it's a better tax advantage for those that have the assets to donate appreciated stock. However, in doing so, you do lose the AGI limitation goes from 60% down to 30%. So if you gave away that same $60,000 of stock in 1 year, you could only deduct 30,000 of it with a $100,000 AGI. So the rules are a little bit different. However, it is still beneficial. Another note at the bottom, gifts made to donor advised funds are nearly 13% of charitable donations now. I think that's a direct result of that increased standard deduction that we talked about earlier. All right, so some of the other benefits of a donor advised fund, they're really easy to set up. Most of the major, or I would say all of the major brokerage houses have donor advised funds available that you can go on and set those up fairly easily and transfer assets seamlessly. The donor, like I said before, the donor can take a tax deduction in the year of the gift. So for cash, it's the value of the cash that goes into the donor advised fund. If it's appreciated stock, it's whatever the fair market value of that stock is at the time you make the gift is what your deduction ends up being. Gifts that are made with appreciated securities have kind of a double tax benefit as well, because not only are you getting the current tax deduction for the fair market value of the appreciated stock, but you're also not having to pay the income tax on that you would if you were to liquidate those funds into cash and then donate it as well. So if you had, let's just say, $50,000 worth of stock and it had unrealized gains of, let's just say, 25,000, you wouldn't have to pay tax on that $25,000 of gain, because you could do an in-kind distribution of those assets into the donor advised fund and be able to take the full $50,000 deduction. And because the donor advised fund is a separate charitable organization, they also don't pay tax on that either, because they're a 501c3 nonprofit. So it has some unique tax benefits. I think it's most beneficial when you do it with appreciated stock. Another couple things, donor does have control over the assets and distributions. So like I said before, if you want to donate a large chunk now but don't know where to give your donations, you have the time to be able to do that. I believe there's an unlimited amount of time. So as long as that fund stays open, you have the time to be able to direct those funds wherever you so choose. And even, I believe, after you pass away, you can stipulate who you would like to direct those assets upon your death. So you could give that right to your children or your spouse or something like that, and they would be able to make those gifts after that point. There's no requirement for annual distributions, whereas if you were to donate to like a private foundation, those do have some annual distribution requirements. There isn't anything like that with donor advised funds. And then donors still have the ability to remain anonymous, which some people do prefer, but you can also make your donations known when you're giving, when you're providing them as well. So they don't have to be anonymous, but it is an option. Okay, so this is probably the strategy that a lot of taxpayers would use now to be able to make sure they get a deduction or a tax benefit from their charitable contributions. I like to call it bunching. So basically what bunching is, it's the process of timing the payment of certain itemized deductions, usually charitable donations and SALT payments, which is state and local tax. So they fall within the same tax year to minimize income taxes. So I'll give you a quick example of how that would look. So if you assume a joint return with $200,000 of taxable income, you have a cap on your SALT deduction of $10,000. Let's just say this couple gives away $8,000 to charity and has mortgage interest of $6,000. That's a total itemized deduction of $24,000. There would be virtually no tax benefit from that because the standard deduction is actually greater than $24,000. So none of those items actually have a tax benefit. So let's just kind of give you an example. So if I know I'm going to give away $8,000 every year, and I've got the means and the ability to do it, I could give $40,000 to a donor advised fund to cover the next 5 years worth of charitable donations. I would get it would be a full $40,000 deduction on that year's tax return, plus your $10,000 SALT deduction, your $6,000 mortgage interest. Now you just went from itemized deductions of $24,000 to, somewhere in the probably the $50,000 range. So that's a huge difference, and that extra deduction is going to give you a huge tax benefit for virtually the same amount of cash flow that you would have normally given. Some people don't like to do this just because they like giving to charity every year because it helps the nonprofits budgeting and all that. But if you're making larger donations, this is best to use. All right, so we're going to talk about donating retirement assets as well. So I know Barb touched on this about donating retirement assets to nonprofits after you pass away, and that's a great strategy, again, because those nonprofits don't pay income tax. So, you know, any tax deferred assets that you can shift between your beneficiaries that you want to have funds and nonprofits, if you can direct them tax deferred assets, that's a fantastic solution. We do have some other options while you're still alive. So the best one is going to be use of qualified charitable distributions. And what that is basically if you have an IRA and you're over the age of 70 and a half, you can actually direct asset or funds directly from your IRA to a charity of your choice. And you can it's basically a tax deduction, but it basically becomes non-taxable. That distribution is non-taxable. And the other benefit is it actually fulfills your minimum distribution requirements for the year, or an RMD. Most people are familiar with it. So that's a tax benefit for those people that are not going to itemize, especially in today's tax rules, and they're over the age of 70 and a half. This is a perfect solution to be able to minimize some of your taxes that way. Again, another example, I think I have one. So another example would be, you know, if you know you're going to give $10,000 to your church this year, but you're not going to itemize, you could direct $10,000 from your IRA and basically fulfill your RMD requirement for that $10,000, and it would not go into your AGI at all. It would actually be considered zero taxable income. That also has a benefit for those of us in Michigan, which I think everybody here is. That's also going to be a tax-free distribution for Michigan as well. So you're not going to pay Michigan tax on that distribution. So we do that a lot, even if people have, or they don't for some reason have enough taxable income at the federal level, but they might pay some at the state level. We still have them do the QCD just so they can avoid the 4.25% Michigan tax. And just a reminder to everybody who's now age 72, RMDs are now required in 2021. There was actually a suspension of RMDs for all of 2020. However, that as of right now, the state, that has not been instated for 2021. So those will be necessary to take before December 31st, 2021. All right, so we talked about what a QCD is already. These are some of the other requirements. You must be 70 and a half or older. The RMD age under this new Secure Act, which was passed in 2019, I believe, and takes effect 1/1/20, or took effect January 1st of 2020. That actually bumped the age up to 72. However, you can still do RMDs for those who haven't reached age 72, but are still older than 70 and a half. So that is still a possibility. That age, for whatever reason, didn't change with the new rules under the Secure Act. So it's a nice benefit. You don't have to be RMD age to be able to do that. The biggest thing you want to be careful of with a QCD is not having any of those funds go to you as the IRA holder. You want them to go directly from the IRA into the hands of the nonprofit organization or the 501c3. So you cannot avoid taxation if that money ever touches your account or the check goes to you in your name, unfortunately. So that's one thing to be careful of. For those that have very large IRA balances, the maximum you can do in a QCD in any given tax year is $100,000. And you cannot donate to donor advised funds. So you do have to give it directly to a charitable organization in that tax year to be able to treat it as tax-free. And then the Secure Act, it did change the rules with the age requirement of being able to contribute to an IRA. Right now, there is no age limit. You can actually, as long as you have the earned income, you can contribute to an IRA. However, if you do a QCD and you contribute to an IRA, you can only take the net as a tax-free distribution. So that's pretty much all I had for today. I just want to thank all of you for being here. Thank you for having me. this is my contact information. If anyone has any questions, I'd be more than happy to answer those for you. I did have this slide up and ready, so I don't know if you want me to leave this up or do you want me to get off the screen share, but I can leave this up if anyone has any questions.
Any questions for Andrew?
Yeah, Andrew, I'll jump in here.
Yeah, sure, Jeff.
Thanks for being with us and sharing this information. So going back to the issue of appreciated stock and transferring that to a charity. If an individual had received stock several years ago, it was passed on to them. And so when they received it, they are now assuming the basis of the individual that passed it on to them. Okay, right?
Yes. Yep.
When that appreciated stock is now transferred to a charity, so there's no taxable event whatsoever, then they don't have to go back to that original basis. Is that correct?
That is correct. The basis is important to have just because it is reportable on your return. It doesn't really have any effect on the deduction amount because the deduction is going to be based on the fair market value, unless it's gone down in value, which there's different rules, whether it's underappreciated stock or the value has decreased below your basis. But if it's appreciated stock, yes, yep, it's basically irrelevant as long as the stock goes from the broker that houses the stock to the charity directly, and it's not liquidated first. You're gonna avoid the taxation on your individual tax return.
Okay, all right, thank you.
Yep.
Other questions for Andrew? Or a question for Barbara?
Andrew, this is Don. What do you have any guess of what's going to happen with the estate tax and the 11 million as we look at?
Yeah, it's, anything can happen. I don't think anything is going to happen under current administration. That's just my gut feeling. It's going to sunset in 2026 anyways. So it's not going to be around forever. It's only going to be available for another 4 to 5 years. So unless Congress acts and extends it or makes a change before 2026, it's going to go back down to the pre-Tax Cuts and Jobs Act levels, which I believe when it first got bumped up when Obama was in the White House, I think it went to 5 million and then it's been indexed for inflation. So it might get re-indexed for inflation based on if it had never went up under the TCJA. It might be closer to 6 or 6.5 million if it ever goes back down in 2026. But I honestly couldn't tell you if anything's going to happen. Your guess is as good as mine.
Thank you.
I think there is a House bill out there that got passed, but I don't know if it's been on the Senate floor or anything like that.
But it would go back to the 5 million and then plus the inflationary increase.
Correct.
So
Yep.
maybe 6.5.
Exactly. Yep. And that level, honestly, we really weren't filing that many estate tax returns for a lot of our clients, unless they had a closely held business worth more than that, or if they were a farmer that just owned a lot of farmland. Farmland's appreciated a lot over the last 20 or so years. So, we really weren't filing a lot of estate tax returns even back then, and we're really not filing them now,
Sure.
other than to elect portability. So that's another big thing that I would say is something to look at for those individuals or married couples that are above what would be the combined estate tax going back to previous rules or previous law. Maybe they're together, they're worth $15 million, let's say. And let's just say one of them passes away in the next 3 or 4 years. You could still file an estate tax, even though you're not going to own anything right now, to claim portability. So you actually don't lose that exclusion. You can actually keep that exclusion, whatever is not used. If that makes sense. So if you've got, let's just say, husband passes away, his estate is worth 7.5 million, so half of that 15 total, and everything's going to go to the wife or the surviving spouse. There'd be no taxable estate. That entire 11.7 million would go directly to the surviving spouse. Now, when she passes away, she's got that 11.7 million plus whatever the lifetime exemption is for her at that time. So that's a situation where that can be a huge tax savings. You know, if we're talking about something that is even $2 or $3 million at roughly 40%, that's a lot of money. And especially if it doesn't have to go to the government, you know, we might as well keep it in your pocket, or, you know, so your kids can use it, or you can donate it, or things like that. That's a huge, huge benefit. But you do have to file a 706 estate tax return to elect portability.
Thank you.
Eileen, did I see your hand up?
Cheryl, when the questions are finished, I have some comments to make about Rotary.
Oh, all right. Other questions for Barbara or for Andrew?
Yeah, Cheryl.
Yes.
So what's the next step if I want to put something in my will, or put Rotary down as a beneficiary?
Well,
That's
Randy,
what
what a
I'm gonna
nice
talk about.
segue into what
Yeah,
Eileen's going
yeah.
to talk about. So,
Exactly.
but Eileen, before you begin that, I'd just
Yep.
like to greet Don Newport. He was just speaking with Andrew. Don, we're glad to have you with us tonight. As well, Deb Krantz, our DGE, signed on after we started talking. And Deb, it's good to have you. I know your schedule is incredibly hectic, and we're glad that you had time to join us. And Paul Hornak from Ithaca, one of our assistant governors, we're glad to have you on the call tonight as well. So Randy's question, very appropriate here. What do I do next if I want to leave something to Rotary? And that's where Eileen is our resident expert. So Eileen, share with us, please.
Okay, well, I would like to bring the focus back onto Rotary. Thank you, Andrew and Barbara, for a great job. But we're doing this because we're Rotarians, and I want to be the one who speaks out and says, look, if you're looking for making a gift to a charity, you can't do better than the Rotary Foundation. And Barbara talked about how you could make a direct gift to Rotary when you die, but I'm encouraging you to make it to the endowment fund. If you want the money you give to be spent by Rotary almost immediately, then a direct gift is appropriate. But I'm encouraging people to give to the Rotary Foundation Endowment Fund, because it's like any other endowment, and the money you give will go to the foundation, and the earnings from that will be spent on Rotary projects in infinity, forever. And in addition, any of you who've heard me talk before will know that I encourage you to, when you designate to the endowment, you can designate all kinds of things that you would like the earnings spent on. Of course, I recommend that you say share. And the reason for share is that if you die and you give $50,000 to the endowment, the earnings of that every year, half of the earnings will come back to the district and be in what we call our district designated fund, or DDF. And so half of the earnings every year in perpetuity will be, the spending will be controlled by this district. And it can be used for things like our district grants, for our global grants, for international work. It can be designated for polio eradication, or whatever kind of major focus Rotary might have in the future. Because remember, when you give to the endowment fund will go on forever, and we don't know exactly what Rotary will look like in 50 or 100 years, but we're pretty confident it'll be there, and it will be continuing to do the good work that it's done so far. So I encourage that you designate your gift to share. And if you don't, and you don't designate it in any particular way, let's say you just give your gift through your trust or your will, or from any of these beneficiary designations, and you just say the Rotary Foundation, the earnings will go into the World Fund. Now, that's a great cause too, but of course, I would like to see the district have control and an opportunity to do some projects that are of particular interest to the district in the future. As Barbara mentioned, Rotary gives recognition for all kinds of gifts of different size, and I'm happy to talk to anybody about those recognitions. But I have found that very few donors are interested in what the society they'll be joining if they give 25,000 or 50,000 or $1 million. The other thing is, I want to stress that we're not just looking for large, substantial gifts. We are interested in small gifts from people of modest means. And I always use the example of if every Rotarian in this district gave $1,000 from one of their life insurance policies, after all of us have passed on, we would have an endowment of over $1 million at the Rotary Foundation. And think of what the earnings year after year on that $1 million could do, both internationally and on projects within the district. I would like to pick up on something that Andrew talked about, donor advised funds. You can set up a donor advised fund within the Rotary Foundation. If you want to set up a gift now, Rotary will be happy to talk about setting up a donor advised fund. It's becoming a much more popular vehicle, as Andrew talked about. It's popular in general, and it's increasing popularity within Rotary itself. The one thing is you want to take care of, to go to your question specifically, Randy, you want to go to whoever is helping you with your estate plan to set up your will or your trust or whatever, and you want to get the designated beneficiaries set up in order for maybe your 401k, your 403b, other kinds of places where insurance policies that might bypass your estate settlement. And Barbara can talk about that maybe better than I can, but I think those things then will not go into your estate to be probated. Now, the reason Rotary needs to know, after you do that, you should tell Rotary what you're planning to do. And the reason is, I've done this myself. I have a lot of beneficiary designations from my 403b, for example, going to the Rotary Foundation. And when I said to them, my beneficiary was the Rotary Foundation endowment share, etc., they wrote back and said, look, we're not trustees. We can't take responsibility for making sure the Rotary Foundation spends it the way you want it spent. So you need to tell Rotary that the gift is coming and how you want it spent. And there's a very short form that Rotary has at www.rotary.org/bequest. And it's a very short little form that says, this is how I want the money when it comes to Rotary. Here's how I want you to invest it, Rotary. And so that's why it's important that everybody tell Rotary the money is going to come when you pass. Of course, if you're going to make a tax deferred gift while you're alive, you of course want to talk to them. You want to talk to them now before the money gets there so that they can make sure it's invested in the way you want it invested. Do you want the gift now to go into the endowment? Do you want it to go into the annual fund? Do you want it to go for polio eradication? Do you want to go toward Peace Scholars? Other choices that you have. But that's why you want to talk to Rotary. I always assure people, I told Rotary about my estate gift oh, probably 15 years ago. And I have to say, they do not bug you about, well, wouldn't you like to set up another charitable gift annuity now? Wouldn't you like to set up something? Wouldn't you like to change your gift now? I think a lot of charities, we're very hesitant to talk to about that because we think they're going to start bugging us. And Rotary is terribly professional about that. If you have some particular problems or issues you want to talk about, as you folks on here probably know, Kevin Kelly is back working with us as the regional major gifts officer. And even though it says major gifts, he's happy to deal with small gifts as well. And we can put you in touch with Kevin, and he will either meet with you or talk with you on the phone and discuss how you can make sure that Rotary invests and spends your gift the way you want it done. So I hope that this will motivate a few people in the district to either set up a lifetime gift, according to some of the things Andrew has talked about, or a gift upon death, as Barbara has talked about. And let's see if we can't benefit the Rotary Foundation as well as our district service projects from this. So thanks again to Andrew from me, thanks to Andrew and Barbara, and thanks for everybody who attended, and hopefully people who might listen to this on a recording. Can't hear you.
Yes, Barbara and Andrew, thank you very much for presenting tonight and sharing this information that you did so very well and helped our understanding. Eileen, thank you for that pitch for Rotary. You know, a lot of this information applies to a lot of aspects of our life, but the Rotary Foundation is one of those that really has a lot of integrity in the way they handle donations and go about doing good in the world. So it is a worthy cause for us to all support. Thank you all so much for being here. There were 14 of us on the call tonight, and hopefully this recording will get out to some others and we will generate some interest in this whole idea of estate planning and making a lasting gift to Rotary. If there are no last minute questions, thank you all very much. I appreciate your time, and good night.